Hey everyone, it's Trey with Benevolent Investors, and surprisingly, today we're seeing widespread market sell-offs in FinTech along with the cloud sectors, but confusingly, that sell-off is also spilling over into some of the more traditionally defensive stocks in finance like Visa and MasterCard too for some reason. So let's take a look at what might be happening in the markets, and perhaps we can figure out a bit more about where things may be going in the coming days too. Check it out. Here we have a variety of stocks from the fintech and payment processing sectors, where we see Affirm, the buy now, pay later meme stock, taking a 9% bath on the day. Sofi down 8%, Square down 6%, but strangely, even MasterCard down 5% and Visa down more than 2%. After hours, we're seeing a tiny bit of recovery happening for the more established players like PayPal, Visa, Lending Club, and MasterCard, however. Cloud stocks, most of whom have benefited from the work from home trend that we've seen since the pandemic started, have also been really hard hit in most cases. Asana lost nearly a quarter of their value in one day, while other players like Snowflake, Zscaler, Fastly, and Okta are all getting pantsed in front of the entire classroom too. The market as a whole, though it started out optimistic, ended up off for the entire day. Though some of my favorites like Micron, Intel, Costco, and Tesla did just fine. And what's even more confusing is that we're seeing reports of retail sales on the rise with expectations and forecasts of a really strong holiday season despite shipping system gridlock. By the way, if you want to learn how to profit off of the worldwide shipping problems going on right now, check out my Zim video link down below. And we also saw CPI, or the Consumer Price Index, jump big in October too, up 6.2% from a year ago. And this means that aside from food and energy, most things we spend money on are experiencing inflation. So if people are expecting inflation and a strong holiday season is coming, you would expect more spending to happen because people want to buy things before the prices go up while the prices are still low, right? And if more spending is happening, then all of these credit card and payment processors should be making more money. And if they're making more money, shouldn't their stock price go up? A quick look at the recent earnings for many of these stocks shows that indeed they are continuing to grow. Here's Sofi showing that they're finally taking over into a positive adjusted EBITDA and showing strong net revenue growth year over year. And there's the whole bank charter thing that's supposedly on the horizon for Sofi too. PayPal is showing growing free cash flows on a mixed quarterly report, but is making moves to cover the eBay loss with a new Amazon partnership. And as a small business guy, y'all know I hate me some PayPal and I will probably never invest in them, but I can't hate on you if you love them. The market's not giving them an easy time at the moment though, even though they're bringing in all this free cash flow. Similar to PayPal, Square's revenues are also down a hair from the last quarter, even though they broke even with a zero net income. And while newcomer Affirm, one of the leaders in the buy now, pay later space, is growing rapidly, a lot of the fundamentals suggest the $123 stock price has already priced in years and years of this growth to continue. And strangely, usually when we see these newer high-flying stocks selling off like this, we see a retreat into safer plays like Visa or MasterCard, but we're just not seeing that today. Visa rarely has double-digit percentage drops within 1 week, but they seem more frequent lately. So let's take a step back and zoom out. It's easy to get really, caught up in all these really micro details, but let's take a look at some of the news headlines. One of the big question marks for the last couple of weeks has been the Federal Reserve Chair position up for grabs. The Fed's main mandates are to promote maximum employment, stable prices, which basically means so we don't have to deal with paralyzing hyperinflation, and thirdly, moderate long-term interest rates. Jerome Powell, originally not an economist who was selected for the position by Trump, has been the Fed chairman for the last 4 years, and his position is set to end in February. The chairman position was up for grabs, but it looks like Biden went ahead and eased concerns of uncertainty in the marketplace by re-electing him over his competitor, Lyle Brainerd. While the majority of the Democrats in office right now would position themselves probably more moderately, the more progressive of them, including Elizabeth Warren, would have preferred Brainerd to take the Fed chair position because she's a bit more open to discussing how the Fed can use its powers to curb issues like global warming. Now, the market always hates uncertainty, and a potential shift to Brainerd, who's generally considered even more dovish than Powell, brought with it a lot of question marks. And when there are question marks, people get scared to invest. More confidence makes people comfortable to invest. While we saw the CPI data last week showing us that inflation's been off the chain, Brainerd's expected policies could potentially send the inflation numbers growing even more rapidly. Her policies in the past have tended to favor focusing on stronger employment numbers, which was, one of those uh, goals of the Fed that I just mentioned, she tends to focus more on employment numbers rather than reining in inflation. And so for Biden, who really needs to get inflation under control if he wants to try and get reelected again, the safer pick was Powell. But at the same time, we saw the yields on the 10-year Treasury note tick up to 1.624% from 1.549% on Friday. This usually happens when confidence is growing, causing the price of bonds to drop due to lower demand, thus the yields on those notes rise. And when this starts to happen, investors tend to sell out of the higher growth stocks that have already priced in a lot of future growth. And I know this is always the stock that comes up on like every example in my channel, but Tesla. Check it out. It sells way less cars than Toyota, and it makes way less money than Toyota. But if you look at the market caps in the bottom center of each of those charts, you can see that Tesla's worth more than 4 times Toyota is currently. That just means that investors are really, really excited about the potential for future growth for Tesla. And typically, when we start to see the 10-year Treasury note yields start to slide up, the market will ease out of these kinds of high-flying stocks and hedge their risk now with some treasuries because they can guarantee a small return on investment with them. And all the stocks we mentioned earlier are stocks that have had massive future growth priced in because of the work-from-home explosion we saw last year. Cloud everything totally exploded for most of 2020, as did other stocks like Zoom, who just dropped their earnings, which turned, even though they turned out okay, despite a lower fourth quarter forecast, is also getting pummeled in a similar way. And so I guess my argument would be the same for stocks like Visa, who's gone from peak to trough up 83% since March of 2020. Now, I'm not saying Visa is necessarily over or undervalued, but I think the markets are going to need to start thinking more about fair valuations again, rather than just grabbing whatever stock seems hot at the moment. One of the things I try to emphasize, especially for those who are serious about lasting a long time in the markets, is that a good valuation will eventually play out in the long term. Yeah, you might double your money on Fastly or Sofi or Affirm like really quickly if you're really on the ball as an active trader. But once these kinds of overarching market dynamics start to kick in, the wind is going to fall out of their sails probably pretty quickly. And there's also a dynamic of diminishing returns. And I'll explain it in terms of cars because I'm a car guy. Let's say you have a completely bone stock economy car from the factory and you want to take it to the track. Even just some small tweaks can result in really massively improved performance on the track. A couple of $100 spent on some high performance tires can completely change the dynamics of the car, yielding way faster lap times. Then, the next step, you're going to get more custom parts and tuning where you can still slash seconds off of your lap times. But once you're into, $10,000 or $20,000 into modifications, the amount of performance gain you get for the dollar you invest is lower and lower. That's the idea of diminishing returns. So in the same way, the higher a stock gets away from a fair valuation, the more outlandishly it has to outperform those expectations on the next quarter and the next quarter and the next quarter after that. And the pandemic and resulting work from home explosion has essentially brought companies in markets like cloud, team working solutions, and FinTech. It's brought all of the next 3 to 5 years of growth and earnings and slammed it into their stock price like right now. So another way to think about it is kind of like a spring or a coil effect. It's like the more you compress a spring, the harder it is to compress it even more, but the harder it is, it's going to bounce back when you let go. Meanwhile, companies whose valuations are a bit more boring, who never really blew up out of the stadium, companies like your IBMs, Intels, Oracles, HPs, Ciscos, these have seen growth, but the market hasn't valued them irrationally high. So if we do continue to see the treasury yields ticking up, the market will continue to flee from these more hypey, overvalued stocks, even if they are showing us that they're still growing their user counts and their revenues. It's just that the spring has been compressed so hard in these last couple of years that compressing it even more is going to take exponentially even more impressive earnings. And these, incremental little baby steps in growth just won't hold it down anymore. So for me, I guess I'm happy with the Jay Powell re-election. We're going to see Brainerd working under him at the Fed, which is likely to open the doors for, more influence and leadership for her in the future. And I don't necessarily have anything against her per se. I haven't looked into her, super in depth or anything like that. But it seems like Powell's the right choice right for now. All that being said, like I mentioned in my newest stock pick video, there's so many factors combining together that make wading through the news so difficult for investors at the moment. Check out why I'm investing heavy in the shipping stock right now to capitalize on all the chaos in international supply chains by clicking here. Love you guys, and don't forget to stay generous.